All right, my name is Andrew Stotz, and we're going to be talking about the all-weather strategy. We had a little technical difficulty, so we're starting a little bit late, but I want to welcome everybody. Feel free as I go through this to ask any questions. Today's going to be a fun one because we're going to look at the performance, but I also have some academic style research that we did that I'm going to demonstrate and talk about. So let me put this onto the stage. Let's get started. So at Phenomena, more than 7,000 followers have entrusted our strategies with about 6.5 billion baht worth of funds. And that's a responsibility we take very seriously. When I do these presentations, I encourage you to ask questions. That's the best part. Also, if you're in Bangkok, let's meet. I've got an event coming up. We've got a special coupon for Phenomena. Attendees here, just use Phenomena, scan that QR code, and I'll talk to you about doubling profit by creating a long-term sales strategy, which we're going to do the Landmark Hotel. So our strategies are global, long-term, and diversified. And I always like to start by reminding ourselves why we're here, which is to build wealth over the long term. Now, we aim to deliver reasonable returns with reasonable risk for an unreasonably long time. That's me when I was young. That's when I came to Thailand, and that's me when I'm going to be 100. Our aim is to create strategies that perform over many decades. My dad retired at 58 and lived to be 82, and he and my mom had 24 years of a happy retirement. That's my mom and dad on their wedding day. And there they are at home before my dad passed away. And mom has now lived comfortably with me for 9 years, not having to worry about money because they invested carefully. Think about living at least 3 decades after you retire. That's why I say long-term is decades, not years. That's mom and myself at El Mercado, one of her favorite and my favorite restaurants. And recently, my mom came to an event at Phenomena, as you can see there, to listen to what her son's talking about. So for some people, decades isn't even that long. They want to think generations. So our goal is to deliver steady returns over the long run. And those are the 3 strategies: the red line, all-weather strategy, the blue line, all-weather alpha focus, and the green line, inflation guard. They all started at 100 in this chart, but they started at different dates. So looking at 2025 year to date, the strategies have performed almost as expected, with AWS on top. AWAF has recently fallen to the middle, as you can see. Now, you can see there's a pretty big fall there that happened in all-weather alpha focus, but later, remember that fall when we later look at the long-term performance. Remember, this is only for the year of 2025. All-weather inflation guard has the lowest return, but also has the lowest volatility. And if we put the world equity on this chart, all strategies have had lower volatility than world equity. And what we can see is the 2 AWS and Alpha Focus have both beaten world equity with that lower. Now, we mix asset classes rather than hold pure equity to try to avoid a portion of equity market downturns. As you can see, that black line shows a big downturn. But it can also mean that we miss a portion of the upside in this chart and any other ones. Now, we revise our strategies every 3 months, and you are here, meaning if you're about to start investing in our strategies or add a significant amount, you may want to wait until the first week of December when we announce the changes, if we have any. So let's look at performance. But before we do that, I'm going to go back and just welcome everybody. I want to welcome you to, hold on, let me get myself up there. Yep. So TT says, hi, John Andrew. TT, nice to see you. There's Supercorn. Good to see you. And welcome to everybody else here. Feel free. This is your chance to ask questions. I'll do my best to answer those questions. I'm really looking forward to tonight's session because at the end of it, I've got a presentation that I think you'll find interesting and valuable as you think about your investing strategy and all of that. So let's go back into the presentation and hold on. There we go. And we're going to talk about all-weather strategy, which gained 2.9%. So here we can see all-weather strategy was 70% in equity, 5% in bonds, and 25% in gold and 0 commodities. You'll also notice that our U.S. weighting has been at 5%, very low. Now, since inception, the strategy was up 74.6% and 31.4% above a 60-40 portfolio. And this is after fees as best that we can calculate them. In October of 2025, the strategy was up 2.9%, which was 1.4% above the 60-40 portfolio. Our 25% allocations to Asia Pacific, ex-Japan, ex-China, and gold did fantastic. Our 25% allocation to China underperformed, but here's an interesting one to think about. Let me grab my pen here, and what you can see is that this is Asia ex-Japan, ex-China, and this is China. And so, in a sense, we are kind of hedged in that case. With China going down, we still have exposure to the rest of Asia. Now, our underweight of the U.S. helped relative because the U.S. was only up about 2%. But, the key thing here is we also got it wrong on China. China had a weighting of 25%. Now, the strategy has added about 6.8% value compared to 60-40 portfolio in 2025. And again, this is after fees as best we can calculate it. The strategy beat a 60-40 portfolio by about 7% in 2024. And here we can see the strategy's lost less than 60-40 on 9 out of 10 worst global stock market days. So a key feature of the strategy is that it aims to lose less when equity markets fall. Let's talk about all-weather alpha focus, which lost 1%. We have an equity weighting of 93%, bonds at 3%, and 4% in gold. Since inception, the strategy was up 19.1%. I had mentioned before to look at the fall, and what we can see is that even though we did have a fall in the prior months, it's still very, very minimal impact compared to the long term. And here we can see the strategy was up 19.1% and 11.4% above a 60-40 and 4.3% below world equity, but with a lot less volatility. And this is from inception. In October, the strategy was down 1%, which was 2.5% below 60-40. So bad performance. And some of you guys asked, is it too late to get into Vietnam? Well, that bet was wrong. So we see Vietnam, China small caps, and precious metal miners all underperform. The strategy, though, still has added about 5.5% value compared to 60-40 portfolio in 2025. And it beat the 60-40 portfolio by 3.7% in 2024. I think, one of the lessons here is you can't win them all. We are taking different bets at times. We're overweighting different countries or different areas. And sometimes we win and sometimes we lose. But what matters is that over the long run, we are able to outperform. So here we can see the strategy's lost less than the 60-40 on 8 out of the 10 worst global stock market days. Now, it's not going to be 10 out of 10 because remember, we're heavily weighted in equity and all-weather alpha focus. So a key feature of the strategy is that it aims to lose less when equity markets fall. Now let's look at all-weather inflation guard, which was up 1.3%. Here we can see 30% equity, bonds at 60, and 10% in gold. Since inception, the strategy was up 17.6% and 7.7% above a 40% equity, 60% bond portfolio. The strategy also has experienced much less volatility. Here we can see the strategy was up 1.3% in October, which was on par with the 40-60. No major outperformance. Our tilts to gold and infotech did well, and our 5% tilt to financials underperformed. Global bonds did well, but below world equity, and tips underperformed global bonds. Here we can see the strategy has underperformed a 40-60 portfolio by about 0.3% so far in 2025 after fees. But the strategy did beat a 40-60 portfolio by about 1% in 2024. Because the performance of a low equity portfolio like this, 40% equity roughly, you're never going to have a huge performance on both the benchmark as well as the all-weather inflation guard. So we have small ups and downs there. Now, the strategy has lost less than 40-60 on 10 out of 10 worst stock market days. So before we go into the research, I'm going to open up for questions. Feel free to ask any questions. Let's go to the first question. Hold on one second. Let's put me up here. Okay. Supercorn says, with AI era coming, how do you see change in asset allocation benchmark as things will change faster? Also, EQ is a way to manage crisis debt, maybe nothing in the future. They often say the more things change, the more they stay the same. I'm a little bit hesitant to say that everything's different. But Supercorn, yesterday I was teaching my students at Chula, and I asked the students, do you think that you're going to be able to outperform in the market with AI? And one student said yes, and one student said no. So we had a little debate. But the point that I would make is that AI is not an exclusive thing. Everybody can use it. So what will happen is that there'll be a competition, just like there's a competition for other tools in the market. So from an AI perspective, I think, it's unlikely you're going to have persistent outperformance from one AI model. Things will change over time. But I also think that our FEMR model will survive the test of time. But as far as investing in AI, I do think that particularly for Alpha Focus, if we see, better and better opportunities in funds that are purely exposed to AI, if on our FEMR scorecard, it looks good, we would consider that. So definitely it's something that I would consider. Now, I didn't really understand EQ. Are you talking about emotional quotient? I'm not really sure. But debt, I think debt will be something in the future. But I also think that the U.S. will figure out a way to get out of that debt. And I have some ideas. But you mentioned, okay, sorry, it's QE. So QE is the way to manage the crisis. Yeah, I think that, the U.S. can just borrow. And if foreign entities, foreign countries don't want to give money to the U.S., then I think you've got a situation where the U.S. will use the Fed to buy to finance basically the Treasury, what the Treasury is selling. So it's a bad situation in the U.S., but I don't see a clear way that they're going to get out of it. So we have to accept that it's kind of there. Pia Watt, good to see you. Yep. And also Ben's, good to see you. And yeah, will you consider have a port with focus on future industries such as energy? I really want to create a mutual fund that's centered around power, because I just think there's a long-term trend there. But we could do a port based upon this and apply our FEMR. I think I'm going to mention it to Alex and Sonsak, and then we can definitely look at that. I'm not against it. I would look at it. All right, let's look at some other. Anita says, hi, John Andrew. I wonder about the Thai government bond, why it dropped drastically and continued decreasing since August. So first thing is bond prices fall when yields or interest rates rise or anticipated to rise, right? So first thing is that if that is happening with government bonds, it's because the market is anticipating a rise in price, or a rise in interest rates in Thailand. I'm not exactly sure about this particular one, so I don't think I can provide a great insight on that. All right, let's keep going. If you got more questions, feel free, but here comes some of the fun stuff. We're going to be talking about some research, and so let's go into this. Remember, I was an analyst and a head of research for many years, and I really love research, and so we're going to talk about don't hold on to your losers. Investors often talk with me about their reluctance to realize losses. They say they don't want to sell a fund with a negative return and realize the loss. They would rather wait until it recovered, until it has a positive return. So why do people hold on to losing investments? That's the question we want to look at. Benjamin Graham said the investor's chief problem, and even his worst enemy, is likely to be himself. Later on, Kahneman and Tversky laid the foundation of a new discipline called prospect theory. And here's what they showed in their charts. Prospect theory teaches that losses are extra painful. Studies on loss aversion found that you feel the pain from a loss 2 to 2.5 times stronger than the pleasure from an equal gain. Behavioral biases often feed off each other or happen together. And here's another one. Besides suffering from loss aversion, anchoring can impact many investment decisions. Anchoring is when we fixate on some past info and then base our future decisions on this. For instance, if you buy a fund for 100, and then you're going to base your future decisions on that entry price. Now, people often take on more risk to avoid sure losses. Studies on loss aversion have shown that we're risk averse when it comes to gains, but risk seeking when it comes to losses. We may take on more risk as we're losing on an investment, thinking we're going to get it back. So, should you hold on to a losing investment? That's the question I'm asked. So let's look at an example. Are you ready? I want you to think about this example. Let's imagine you invest 100 baht in this fund. You put in 100 at the starting point. And after about 3 months, you've lost 32%. What would you do? How would you feel? Now, 6 months later, the fund has recovered, but you're still down 13%. In other words, you didn't come back to the 100, so you're reluctant to sell. What would you do? You would probably hang on. And another 6 months passes, and you're now down 35% from your initial investment. What would you do in that case? You're going to say, as most people say to me, that I'm going to wait until it comes back to 100. And after 3 months, imagine that the fund is recovered again, but you're still down 16%. What would you do? Now, after 7 months, you're down 20%. What would you do? Would you sell if you were down 48%? What about 74%? Are you enjoying the ride? I love this video. So, would you sell when you're down 80%? Or how about if you're down 88%? What would you do? Now, do you know what this chart represents? I'm going to ask you now and look for your answer. Do you know what this chart represents? Some of you guys may know what that chart represents. Any guesses? What does that chart represent? Well, I know for my Thai viewers, They know that because the older ones in particular lived through it. Let's look at that in a little bit more detail. Let's put a time scale on it starting in January of 1994. In fact, I started working right before this point, about 4 months before this point. I started working in the Thai stock market. And this is the set index during the Tom Yum Goong crisis. It was down 88%. So the question is, okay, you rode it all the way down. What are you going to do now? Do you know how long it would have taken you to recover from that 88%? Well, the bottom was reached on September 4th, 1998. The set index was down to about 200. Almost 10 years later, you were still down 48%. In fact, it took 19 years to recover. So if you had sold at a loss at some point, you could have invested that money somewhere else and it would have recovered faster. Warren Buffett once called Peter Lynch asking for permission to quote him in an annual report. He was quoting what Peter Lynch said, which was, selling your winners and holding your losers is like cutting the flowers and watering the weeds. In other words, we should let our winners run and cut your losers. In fact, that recovery in the set was short-lived because we're now still 26% below the 100 amount that you put in back in January of 1994. Remember that stocks are volatile and you need to manage that volatility and drawdowns and your emotions related to it to get the returns. Also, you don't want to be exposed to only one single market or single stock. Now, that's the set index. And I know some of you guys may have lived through it. And let's just see. BT Wu says paper money value. Well, it's paper money, but it's real money in a sense too. Supercorn says, yep, it's a set. You got it. And Kunatip said the set, correct. So here's a question. I'm curious from NRT. I'm curious why some of the money is flowing into banking and finance. Could this be sector rotation? And what are the reasons behind it or any indicator? In fact, I'm going to be doing some presentation to a bank on Monday about relative performance of Thai banks relative to global banks, as well as their bank performance. And the answer to your question is that Thai banks have slowed down their lending growth till it's pretty much negative now. And they've cut their costs. They've set aside provisions. They've got strong capital. They're just kind of waiting it out. So in that sense, what we have is banks, are probably, in pretty good shape right now. And so that could be one of the reasons why it's happening. Mark said all in. Okay. So that's the reason we use FBMR. Correct. Supergone. All right. Talk to Kesedit. Good to see you. Yep. All right. So how does the escalating geopolitical competition between the U.S. and China over rare earth elements influence investment strategy and valuation metrics within the global tech sector? Well, I think that, it's definitely an issue, and the strength of the U.S. government is based on the strength of its military. And the U.S. military is based upon rare earths. And so the U.S. military can't get the rare earths from China. They either have to get it somewhere else if they can, or they aren't going to have the military might to back the dollar and back their position. So I think that is the first thing we have to understand, is that it is very critical for the U.S. Now, they're going to accelerate mining, and they're going to go out and do deals with places. A few years ago, I talked about how World War 2.5 has already happened, and World War 3 will happen in Africa, because that's when America wakes up to realize they're blocked from getting a lot of the rare earths there, and therefore those are all going to China. And then you can expect that America is probably going to have a little bit of a fight in Africa against China. And it has been interesting. I mean, even you've seen Trump talking tough to Nigeria. So overall, I think that it's going to get worked out because basically the U.S. is going to do deals, and they're going to do a deal with China to make sure that they've got access. So that gives you some picture on that. Let's go back to the presentation. So let's look at some global stock market crashes to remember. So here's the one that we just talked about, the Tom Yong-gun crisis, or Asian financial crisis, as we called it during that time. You can see it was just a little tiny thing in the global markets. Next, we had the dot-com crash, which was pretty huge, very huge. And then we had the global financial crisis. Then we had the COVID crash, which turns out was just a flash crash, basically. And then we had the 2022 bear market. So we've had a lot of different crashes. Now, investing in equity only, you need to be prepared for 50% plus market drawdowns. This chart basically shows maximum drawdowns for various countries. We can see that world equity, which is the 56, the bar that represents the 56 on this chart, fell 56%, and US was pretty close to that at 57%. And Thailand, of course, as we just seen, was down 88%, and Iceland was the absolute worst, down 95%. Also, remember that individual stocks can fall to zero. Now, I did recently have a conversation with my former boss, who had made some pretty aggressive buys in the Iceland market, and so that he did that a long time ago, right after the 2008 crisis, which was pretty amazing gains that he got. Now, it took world equity 5 years to recover from its 56% drawdown. That's an amazingly short amount of time when you think about it. The US market recovered in 4 years from its 57% drawdown. And here is the record. Taiwan took 30 years to recover from a 79% drawdown. And of course, Thailand recouped the 88% in 19 years. So some markets have yet to recover. This tells us not to hold on to losing investments for too long. So I'm going to mention about this for just a second. I'm going to come back to the reason why I'm talking about this is because recently in the presentations that I've been doing at Phenomena, I've been showing that our performance has been very strong. And I know people are happy about that performance. Me too. Very excited about that performance. But I also want to remind people that what goes up must come down. In fact, there was a great song when I was a kid called Spinning Wheel. And for the older people listening, it said, what goes up must come down. And I think you've got to be prepared for that. And I believe for the next time that I speak, we are going to probably, I've talked with Alex and Sean a little bit, but I want to do some simulations of what could happen to AWS. But today, we're going to look at that in a little bit more detail about what has happened to AWS. So let's go back into that. And I'm going to go back into the presentation and talk about, how do you avoid being your own worst enemy? Well, first, use zero-based thinking, and it can help you deal with loss aversion. So, what if you didn't own that fund before it fell by 30%? Would you buy it? Would you buy it after it fell by 30%? If you say, no, I wouldn't, then you've got to sell it. So it's not just paper loss, but just being aware of your anchor and that it can become irrelevant due to new information. You should be able to deal with the anchoring bias. And a stop loss is a powerful risk management tool. We use this for single stocks, but we don't use it for funds because funds are pretty diversified, so you don't get that type of volatility. But we do use stop loss in the sense that we use zero-based thinking, and every 3 months we go back to zero. An investment framework can help you overcome behavioral biases. Markets can trigger emotions and costly mistakes. We rely on data and structure, not feelings, to guide every decision. And that's our FEMR framework. Jen Simons said, only in cases of extreme volatility or if the signals appear to be weakening does the firm sometimes manually cut back. We do not override the models. Discipline is the key in investing. And I would say quantitative investing requires even more discipline to stick to your investment framework. I remember, I'm going to talk about some different experiences that we've had with the all-weather strategy. But one of the things that I want to mention about is that if you're doing a quantitative type of model, you can be in a period of time where the model doesn't work. And when we first started doing quantitative models, we had a model on the Thai stock market, and it didn't work for the first year. It didn't work for the second year. It didn't work for the third year. It didn't work for the fourth year. It didn't work for the fifth year. Now, how many people are going to have iron discipline to stick with the strategy? Now, the strategy wasn't like massively underperforming. It just was not outperforming. And then in the sixth year, it shot up. And that Thai quantitative strategy we have, we didn't change it. And eventually it comes into favor. Now, you may say, oh, yeah, well, you gotta change your model when times change. Well, the risk that you face with that is that if we had decided that we were going to modify that Thai quantitative model, we would have modified it so that it would have outperformed in a flat market, because the market at that time was flat. Okay, we would have based the model originally on a rising market. Then we would have reoriented the model to a flat market and said, oh, now we can outperform. But then what will happen is the market will go up again. And when it does, you now have somewhat of a defensive model that's not going to work in the upcycle. So with these types of models, you really have to have some consistency. So let's look at this. Let's keep going. And let me go back to the presentation. So we follow our framework with iron discipline. Every 3 months, we consider our allocations and use zero-based thinking. Regular revisions and diversified mutual funds typically help to avoid huge losses. And it's important to remember that, let's just say that we have a 25% weighting in gold as an example. By the time we rebalance, that gold weighting may go up to, let's say in this case, we could be up to 30%. And at 30%, we're going to rebalance. And let's imagine that we're staying in gold. We're going to sell that additional 5%, take that gain, and then maintain the position in the 25%. So back to our target weighting. So there is a little bit of trimming that's happening in that process. But let's look at AWS. We're going to go back in time to when we started AWS, which was February 2019. And basically, very quickly, the COVID crash hit fast and furious. And the global stock market drawdown only lasted about 40 days. But that drawdown was pretty deep at about 33% that the market went down. And what we can see here was that AWS drawdown was not as deep, 13% less than world equity and a little bit less than the 60-40. And the drawdown of AWS also lasted a week less. So now, however, it took us longer to recover. What you can see is it took us almost 4 months longer than world equity to pass the previous peak. And let's look into what happened and the lessons that we learned from this period. So this is how the COVID crash unfolded for AWS. And I haven't discussed this publicly yet, so this will be the first time. At the start, we had 65% in equity, 5% in bonds, 25% in gold, and 5% in commodities. We had our regular rebalancing during the early parts of the COVID crash, and our FEMR framework told us to reduce equity to 45% and raise bonds to 25%. Markets continued to fall, and the high yield bond spreads signaled trouble in corporate bonds, particularly in the US. And we were looking at that chart as it was blowing up. It was, incredible. And basically, what was happening is high yield corporate bonds were being sold down, and that means their yields were rising relative to regular corporate bonds or relative to government bonds. Now, we changed our global bond allocation to a time money market fund rather than a mixed bond fund with global exposure to corporate and government bonds. We did this because we were concerned of the bankruptcies potentially happening in the US. We then decided to make an extra revision. This is the key. And before I go on, this part actually worked out well because we were buying the TMB asset management bond that is almost 2 days after we got out of it, basically said they wouldn't be able to do any redemptions. They had to wait because of the turmoil in the markets. So we got out of that just in time and into the time money market. But then we decided to make an extra revision where we reduced equity to 25% and exited commodities while increasing bonds to 45 from 25 and gold to 30 from 25. So we felt like it was a huge crisis period, and therefore we wanted to be a little bit more defensive. So we overrode the model. Now, these actions helped AWS to fall significantly less than world equity. And this is in line with our goal of reducing the downside compared to an equity-only portfolio. So let's go back in time and see what happened next. Let's look at some excerpts from our reports that we published through Phenomena on the 3rd of March, 2022. If COVID-19 becomes a global pandemic, things can become a lot worse. There's always a risk of overreacting in times like this. The all-weather strategy aims to reduce the risk of an equity-only portfolio. As such, we are comfortable to overweight defensive assets, gold, and bonds. Hold on. Hi, Mom. I'm on the video right now on YouTube. So you want to say goodnight to everybody? I'll see you tomorrow morning. I can come in and see you after this. But I'm live on YouTube. You want to come over and say hi to everybody, or you want to go to bed? All right, I'll see you in a bit. Now, sorry about that. Mom comes first, family first, right? Excerpts from our report on 2nd of June. We're now reducing the weight in bonds to 30% from 45%, with the allocation going back to equity. Equity was up to 40%. We continue to focus on downside protection, even if it means lagging world equity in the short term. So part of what we were concerned about is big losses. Now, we applied our judgment to keep a lower equity allocation than the FEMR framework suggested. This was really one of the major overrides that we did. So that was June. Let's look at September of 2022. We're still cautious on equity. However, we see that equities have good momentum. The M in FEMR and the asset class could move further in the next 3 months. With 30% in gold and 15% in bonds, we still consider our weights conservative. Then in December, we said we acknowledge that the further positive news around a vaccine can drive markets further. Stimulus news can drive stocks to new highs, and we increase our equity allocation to the maximum at 85%. So in 2020, we overrode the FEMR framework to stay more defensive than it suggested. We didn't override it completely, but we overrode it a bit. Now, on the positive side, we reduced the downside relative to an equity-only portfolio significantly. The negative was that it took us longer to recover and catch up with the 60-40 portfolio. So downside protection is a key focus of ours, so you could understand why we did it, but we also got hurt on the upside. And we learned some important lesson that I want to share with you. And you hear me every time we meet, talk about it. Remember, the sixth pillar in our 6 pillars of investing is continued learning. Keep improving your skills by staying informed and reflecting on both wins and losses or mistakes. And that's what we've been doing. 2020 taught us that we should be cautious on overriding the model. And to remember pillar 5, and this is why you always hear me talk about iron discipline. Pillar number 5 is maintain discipline. Stick to your investment plan and avoid emotional decisions, especially during market swings, which we have done ever since. So the 2022 bear market was deeper and longer than the COVID crash. But again, AWS lost less. We can see it lost 12% less than world equity and 4% less than the 60-40. And AWS also bottomed earlier and recovered faster, yet it took still almost 1.5 years to recover. So reducing the downside generally comes at a cost of a lower return. However, we have also almost matched world equity returns and beaten a traditional 60-40 with a wide margin. So the key takeaways are: don't hold on to losing investments. Drawdowns can be deep and it can take decades to recover. An investment framework can help you overcome behavioral biases. Zero-based thinking, regular revisions, diversification, and stop loss can also help. And AWS has offered much lower drawdown than world equity and much better return than a traditional 60-40. And I think the most important thing you learn is that we are always learning and trying to improve. Now, before we get into Q&A, the next Valuation Masterclass Bootcamp happens on February 6th. So basically, people who take the bootcamp will write 4 professional valuation reports in 12 weeks, learn to think and act like a pro, and prove that you can deliver under pressure, because it is very tough. So for Phenomena viewers, you can get an extra $100 off. Just use the code Phenomena at valuationmasterclass.com. All right, it's Q&A time. So I'm going to go back to the presentation and let me bring myself up here. All right. So let's go through some questions. Here's a question. Kunatip says, I'm interested in AWIG. May I ask, what is the minimum equity fund allocation in AWIG, and what is the maximum allocation for a single fund such as KT bond? So let me try to answer this question. Basically, what I would say, hold on one second. So equity on average is about 30%. We have a 20% core allocation to world equity. And then we put in 2 5% tilts on the, on the upside for equity. So that gives us the 30% total in equity. For bonds, we hold on average 60% in a mix of global bonds, tips, and money market. And also, we can change the total bond allocation up to about 75. Now, global bonds currently are at about 45 to 50, and that's the KT bond. Now, we are working on a bond fund that we're considering, and we'll have more information on that coming. Now, gold in the AWIG can be 5 to 10%, and we can tilt 5% to REITs and commodities. So hopefully that gives you a little bit of picture of what we can do and what are the constraints when it comes to the all-weather strategy and the inflation guard strategy. RTM says, is it possible to release AWS with dividend paid or auto redemption version? Good question. I don't know the answer to that, but I'm going to ask Phenomena to help us to answer that, and then we'll see. So I'll take that on board. ABB, hi there. Okay, Supercorn, the time market is delta only. Models not work. Yeah, it's true. Like, if you take out delta, then Thailand doesn't really have a tech sector, but if you leave that in, it does. Yeah, Thailand's tough right now. It's very tough. JC, I intend to hold AWS fund over 15 years. That's great. By that time, I'm going to be 75 and I will be ready to run at the park and keep going with this all-weather strategy, which I enjoy so much. What is your opinion for China anti-involution? Is this new policy conflict with previous dual circulation? That's too complicated for me. I don't actually know anti-involution, so maybe you got to ask someone else. Let's continue on. We have another one. Life is short. What is the date of the next reallocation? The date of the next reallocation is first week of December. Yeah. Good night to mom, JC. Yeah. Mom was very nalak. Yes. Mom is, she just finished her dinner. She had some cheese and crackers, and a friend of mine came over and he brought her a bottle of sparkling wine, which was fantastic. So she had just a little bit, just a little bit before bed, and she likes that. Yes, BT Wu says, wish her happy and healthy. Thank you very much. Yeah, mom's enjoying it. Yeah, 2022 correlation totally broke down. But let's talk about that for a minute, in case it did, because sometimes I wonder about the idea of correlation during market crashes. What we generally would say is that correlation goes to 1. All assets collapse, basically. So what do? Well, if there's no asset that you can own that doesn't, collapse at the same time, then you're stuck. And the point is that the best solution most of the time in a crash is to just hang on. Now, obviously, the best solution is to sell before the crash, but nobody can perfectly time that. And so the other solution is hang on. Correlations will go back to their normal. And when they do, then you're back to normal. So I think that whole concept of correlation going to 1 is kind of it's not worth even talking about in some ways. Yeah, just go to valuationmasterclass.com to join the next boot camp. Use the code phenomena, and there we go. Okay, we got another question. Remember, if you have any questions, feel free to ask them now. We're just got a few minutes left before I got to go in and put mom to bed and say goodnight. Marry my cat. Oh, wow. The reason I still hold on to loss is because I'm not certain if I stop loss here, I'll be able to make money somewhere else. That's a pity, me, but I like zero-based strategy. We'll relook. So the way to think about this, marry my cat, is there in this world now, particularly in Thailand, you have, 1,000 different options. Let's just say you have 1,000 different stocks or funds that you could buy. So there they are, all listed out, 1,000. Let's put them in a column. Now, if you didn't own any of those funds or stocks, you would look at them and you would evaluate them and you'd say, okay, these ones at the top, I think, have the most chance of having a strong performance. And these ones at the bottom, I think, have the least chance. Now, if you look at the top, you've got 10 or 20 options up there that you start researching and all that. And then you think, okay, I like this one and that one. Okay, great. Now you've got 1 or 2. The stock or the fund that you're holding that's gone all the way down, chances are is not in the top of that list. And so particularly in Thailand, where you don't have capital gains, it's even more easy. Now in America and other countries where you have a lot of capital gains, it gets a little bit harder. But in Thailand, there's no capital gains. So, or capital, so the point is that many people don't want to act because of tax impacts and all that. But in Thailand, there really is no reason why you wouldn't say, I'm going to get out of this and then I'm going to go into another. So that's my thought on it. That's my comment. Let's just see. We had a Madura said, what's one of the common anchors you've seen investors getting stuck on? Well, I think the number one common anchor is the price that you bought it at. That's the one. Everybody gets stuck on that one, the price you bought it at, and then you can't get away from it. And so that's what I would say about that. Well, it's 6:57. I want to thank everybody for joining. We had a little bit of a mess up at the beginning, but today you got some understanding of the performance of the strategies, but also you heard about a time that we did override the model, and it worked on one part, but it didn't work on another. It worked to prevent the downside in a real crisis, but the upside didn't come back as fast as we thought. So you could probably say it was neutral. So therefore, every single time we get the feeling like we want to override the model, we ask ourselves, right? And we tell ourselves, stick to the model. And whether that's the FVMR model or that's your own model, build it. Build a high quality model and systemized way of thinking. And then when times get tough, stick with the model. Now, if your model's not good, you need to improve it so that you're comfortable sticking with the model. But with 30 years of experience in finance and my education and all of that, I feel comfortable with the model that we've developed. So I want to thank you all for joining and for being a part of this. Thank you for your questions, and we'll do our best. Remember, we will be rebalancing the strategy or reconsidering the strategy at the first week or so of December. And so we will see you at that period. We may make no change or we may make a lot of change. We don't know yet. All right. Have a great evening. I'm going to go in and see Mom before she goes to sleep. Take care.